everybody. Wednesday night, we're back here. Come on in, come on in, come on in. Get ready. Get your pens and notepads out. Get your coffee if you need some coffee, like me. I don't have any, but God knows I need some. And let's get straight into our session tonight. Tonight might be slightly shorter. Well, I hope it is slightly shorter than normal. Let me say that. I don't have any intentions for it to be a long session. And we are dealing with candlesticks. Now, 1 second. Let me make sure. Oh, yeah, my screen is cool. Let's get rid of this graphic. Right, so now the average trading course deals with candlesticks pretty early on. And when you go through the Market Breakers course, we do deal with candlesticks pretty early on. In the mentorship, in the mentorship webinars, we've left them till slightly later than you would normally have anticipated intentionally. There's a reason for that. And the reason is we don't want you to get too hung up on the candles until you understand to some degree how price moves. And now that you have begun to form an understanding of how price moves, we now want to look at this candlesticks specifically as a measure of tracking price action. Let me repeat that. All candlesticks are a measure of tracking price action. There's nothing magical about them. There's nothing special about them. There is no magic candlestick pattern like some people teach. Tweezers, dojis, haramis, tracks, parallel tracks, shooting stars, hanging mans. We will look at this. You're going to see these in the Market Breakers course. We're going to deal with the different kinds of candles and what they mean and all that. But for the purpose of the mentorship, now bear in mind, the Market Breakers course gives you a theoretical foundation of what's going on. These mentorship classes, good to see you, Reggie, good to see you, Gerard. These mentorship classes are simply designed. Give me a quick second, everybody. So the mentorship classes are simply designed to make it make sense. Let me repeat. So we're not looking at any extraneous information in the mentorship classes. They are designed to practically pull the information that you're learning in the Market Breakers course together to give it practical application. And so today and next time, there's 3 or 4 parts of this candlestick section. We're not going to be looking at any of the give me 1 quick second. Sorry, give me a quick second, guys. So yeah, we're not going to be looking at any of the unnecessary extraneous information. It's simply going to be, how does this apply? How does this apply to trading directly price action? So, as usual, in the mentorship webinars, everything I do is with a live chart. There's a reason for it. Things look nice in a PowerPoint presentation. They look nice in a PowerPoint slide. I can show you nice fancy blocks and nice fancy looking things. But then when you open a chart like this and you look at it, if you don't understand how to convert that PowerPoint into what's happening in front of you, you will get in trouble. So you notice that I don't bring PowerPoint slides. I have them from the MBC, but I don't bring them into the webinars because they're not going to help you. So first things first. We are trading, and I say this all the time. I want you guys to hear this till you're blue in the face. We're trading price against time. Never forget that. As a technical trader, you are trading a graph or chart. There is a horizontal axis, that's time. It's time measured in months, weeks, days, every 4 hours, every 1 hour, every 30 minutes, every 15 minutes, every 5 minutes, every 1 minute. It is still the same thing. You are measuring price versus time. So that's the time block. The price block is simple. Pips. If there's anybody who hasn't been through this already, you see this price here, the pip is the 4th decimal place. The pip is the 4th decimal place in a price of a currency pair. If you are dealing with a Japanese pair, a pair that has the Japanese yen as part of it, then it is the 2nd decimal place. And so you're trading price. One second, what's going on here? Fine. You're trading price against time. That is very important. Why is that important? Well, for the simple reason that all a candlestick is, or candlesticks, or Japanese candlesticks as we call them, all they are a means of measuring a unit of time in the price flow. The MetaTrader account gives you 3 ways. One is a bar chart. That's a bar chart right there. And I know many traders who like bar charts. When I first started trading, I was using bar charts. They work. They give you the same information. A bar chart gives you, look at this for instance here. It gives you an open, a low, a high, and a close. Same information as a candle. It just depends on what looks nicer to you. I personally don't like them because when it comes time to start drawing zones, with some experience you can draw them, but it takes, to me, it's not just that good in terms of spatial recognition. A line chart is this. It can plot either the high or the low. And that says the highest price in that candle, if this is day, the highest price in the day, or the lowest price in the day, as a line chart. The problem is here, for instance, this day here, right? The 10th of June. All it tells me is either the open, depends on how you set it on your chart settings, either the highest price of that day or the lowest price of that day. Now, when you compare that with this chart here that gives you 4 prices from that day, there's a lot less information. As a technical trader, the only reason why you want a line chart is just to get an idea of how price has been moving. You can't trade off those with any kind of consistent success. The last one, which is the one we prefer, is the Japanese candlestick. And it's called a candlestick because the people who invented it in the Far East thought they looked like candlesticks. And every candlestick has 4 prices that are important to you. The open, the low, the high, and the close. The open, the low, the high, and the close. Now let's drill in a bit further here. I'm going to take a random candle. Let me take one that has clear. Okay, so this here. So I'm going to work for the sake of this point with this candle here, right? The one in the middle of that colored section. Now, on my chart, white candles are bullish, meaning they're upward candles. Black candles are bearish. You can customize your MetaTrader platform or any other trading platform like TradingView. You can make it look different colors. Like, for instance, this is, I know some of you like these kind of charts. For me, they just don't work well with my eyes. So some of you like colors like this, or you can get something like this. These are the standard ones, green and black. You can actually change it up. You can decide. Let's see. I can make the background, I don't know. I can make background blue, right? And I'll make my bullish candles, I don't know. Let's make them something funny. Let me make them green. No, green. Green. I wouldn't see that on blue. I'll make them yellow, gold, and my bearish candles, I'll make them burly wood. So if that's your thing, great. It's not mine. I mean, my eyes are literally hurting me right now, just staring at this screen. So I'm a black and white kind of guy. Ooh, that's a lot better. So this candle here, if it's a bullish candle, it means that the open is at the body, at the lower part of the body. Actually, let's deal with that first. So every candle has a body and a wick. This is the body of this candle here. The rectangle is the body. So that there is the body. The bit that looks like a rectangle is the body. The wick, for the advanced students, just stick with me. Don't run away. Oh, I know this already. Stick with me. In about 5 minutes, I'm going to start dropping stuff that will benefit you. That's the wick. The wick is the long, thin line that runs in between the body. That's why it's called a candle. It has a body and a wick that burns. Now, some candles have long, like this one here, for instance, here, has a very long wick. That's that black bearish candle there, and a very small body. So for this candle, that's the wick. Or sorry, this is the wick. From there to here is the wick. And this black piece in the middle is the body. And so some candles have long wicks, small body. Some have long body, small wicks. Some have both. Some you could, like this candle, for instance, is all wick and no body. Look at this candle here. And they all mean something. All wick and no body, that one there. But coming back to the one we started with, we're working with this one. For bullish candle, the bottom of the body is the open. Because think about it this way. It's bullish because price started and closed higher than it opened. So for my color scheme, the white candle means price closed higher than it opened. So the open is down there. The close is up there at the top of the body. The bottom of the wick is the low of the candle. The high of the wick is the high of the candle. So this candle did this. It opened here. It went down to form a low. It went up to form a high and then closed. 9.5 times out of 10, when you see a candle like this, the order, let me write that on the screen for you. There are exceptions, but 9.5 times out of 10, and please write this down in your notes if you're taking notes. For bullish candles, the order is one open, 2 low, 3 high, 4 close. This is extremely important that you remember this. This here is one of the foundational truths that changed my life as a trader. As simple as this statement is, it was the key, or one of the keys. This and the market structure break were the two things that changed my trading life. Once I understood these two principles, I went to another level as a trader. And I have given them, or we have given them to you here at the start, both of them. This should behave itself at the start of your mentorship, because I realized one of the reasons why many traders fail is things are treated as advanced that should be foundational. Many of the things that some traders or some trainers teach as advanced concepts are actually the foundational principles. You must understand that if you expect a bullish candle to form, the order in which it will form is it will open, it will go to the low, then run to the high, and then close. The distance between the low and high is the period range. So if it's a daily candle, it's a daily range. If it's a 4-hour candle, it's a 4-hourly range. If it's an hourly candle, it's an hourly range. In essence, yep, Kiran, sadly, it's new information and I wish it wasn't. Because this is why new traders get burnt. They don't understand these kinds of things. So the range that price forms is all the way from the bottom of the wick. Let's use this candle here. To the top wick. So this day, the daily range was 133.8. 134 pips was the daily range of this candle. However, the distance between the open and close is what I call, this is what I call the difference between open and close, right? Is what I call the order profile. And I will explain what I mean by order profile. Notice the word profile is there. It's the same word in liquidity profile. There's a reason. I will come to that, not today, but as we go on, probably in part 3 of this candlestick section of the course of the mentorship. So for this candle, when we opened here today, or this particular day at 1.2400, we were going to end up closing at 12467. So 67 pips was the difference between the high and, or the open and the close. So price was going to have moved functionally a block of orders, a profile of orders, an array of orders was going to have moved price. Yeah, Reggie, that glossary of terms is in the Market Breakers course material. You're going to get it. As we break them down systematically, section by section, at the end of every PDF or every section of modules, there'll be a glossary of terms. So 67 pips is the order profile of this candle. but the total range of price was 130 pips. This then gives you two ways to trade this candle. There's two ways you can trade this candle. The first way is to get in at the open and get out at the close. The second way is to pre-analyze where you think the low is going to form and where you think the high is going to form and take the full ride. The full ride is 130 pips. The partial ride is 67 pips. You have two ways to take the partial ride. The first way is you get in at the open, you sit while the elevator goes the wrong way, while the bus goes out of your way or the train goes out of your way. Then you come back while it goes to the end of the track, to the end of the bus route, or from the bottom floor all the way to the top floor, and then you get out at your destination. If you are a swing or a position trader, if you are an end of day trader, if you don't have the time to analyze intraday, that's how you're going to trade. If you can put a little bit more time and effort into it, you could wait for it to form the low, come back to the open, take your entry at the open. In essence, if price comes, this could be a test. So Kieran, I want you to listen to this very carefully for your style of trading. Your test could be watch that open and only set an entry, set a stop entry a few pips above the open of that candle on whatever time frame you're trading on, and catch the ride up. Let the filter that price formed a low and came back and passed the open confirm to you that it is actually a bullish day, 4 hour, 1 hour, 15 minutes or whatever, and then ride it all the way to the close. Except on a day like this one here, where price went down, went up, and closed at the same level. This is the only kind of day where, or sometimes price will fake you out and come back and close down there. But that's a way to do it. But the most profitable way to trade that candle is to figure out where the low is going to form and get in there. Figure out what the high is going to form and get out there. Good question, Reggie. There's no way of knowing while the candle is forming. Yes, there's no way of knowing while it is forming, but I'm about to show you from the previous days or weeks or hours, whatever time frame you're trading, coming into that candle, you can have an informed guess of where the highs and lows are going to form. And that's what I'm going to show you today. You can have an informed guess of where the highs and lows are going to form. So that's for bullish candle. Now, for bearish candle, let's reverse that principle. For bearish candles, the order is, one second. For bearish candles, the order is this is the order in which a bearish candle almost always forms. Again, I'm talking 9 times out of 10, 90% of the time or more. It will first open, Then it will form the high. Then form the low, and then close. That's the order in which a bearish candle almost always forms. And I repeat, we're talking 90% of the time or more. It is almost invariable. The exceptions are very few and far between. And the only reason why there are exceptions are because there are market maker manipulations going on. And so, in this case, the distance between, in this case now, the high, because it's going from the high, and the low is the period range. MetaTrader needs to behave itself with me today. And the distance between the open and the close is the order profile the same. So for bearish candle, let's use this one here. Those are the wicks. That's the body. So for bearish candle, price will almost always open. The open now is the top of the candle because it's going down. So for bullish candle, the open is the bottom of the body. For a bearish candle, the open is the top of the body. It'll open. It'll form a high. It'll run all the way down and form a low. And then it'll close. That is almost invariably how a bearish candle forms. Again, there's multiple ways to trade this. Number one is you can just get in here, sit through the retracement at the start, go all the way to the end and sit through the retracement at the end and then get out there. That's the least stressful, least time intensive way of trading. Alternatively, you could let it open, let it form the high, wait for it to come back and pass the open to confirm it is bearish, and then follow through with the ride, and then wait for it to retrace at the end and get out. Or if there was a way that you could guess where the high was going to form and where the low was going to form and get in and out, that would be amazing, wouldn't it? Now, Reg's point from earlier on was there's no way of knowing where the high and the low are going to be when the candle is forming. And my answer is yes, there's no way of knowing for sure. However, there are ways of having a good guess. So for the purpose of this, I want to draw your attention. I've just drawn these lines here, right? I'm going to make this red because this is for a bearish candle. And I'm going to make this green because it's for a bullish candle. Now, I should have said this at the start. Remember, price is a fractal. Price is a fractal, which means it is a thing that repeats the same properties no matter how often you divide through it. In essence, it will behave the same way on a monthly chart as a weekly chart, as a daily chart, as a 4-hour chart, as a 1-hour chart, as a 30-minute chart, as a 15-minute chart, as a 5-minute chart, as a 1-minute chart. It's one of the things you have to believe about price action at the beginning, because all your other understandings will take their cue from there. You must believe price is a fractal. Why? At the start, because your instructor tells you, but as you go on, you will see it for yourself. That the same rules apply in institutional order flow at every price level. So this is a daily chart, but my point is this works on any time frame. These red lines delineate the high and the low of this candle. The green lines delineate the low and the high of this candle here, right? By looking backwards, in essence, before those candles formed, like Reggie said, you can't know while they're forming, true. But before those candles formed, can you see on your chart anything that could have given you some estimation of where each of those highs and lows would form? So I've taken them off the screen. In essence, days before those particular candles formed, can you look at your chart and see if you can come up with fairly accurate guesstimates of where those levels were going to be? I'm going to be quiet while you take a look. If you see it, please type in the comment section. Anybody? Do you see it? If you do, please type it in the comment section. Gerard says previous price levels. That's correct. Reggie said support and resistance lines. That's also correct. The point is, those levels are points in the past where other candles formed. Either they're opens or closes or highs or lows. This is particularly important. Previous price levels, because market, remember we looked at this 2 weeks ago, market makers are position traders. So significant price levels are valid for extremely long periods of time. For instance, look at this top here. Look at this here. This candle's high is the exact same high of this one just 2 days later. That is extremely common. Look at that. They share the exact same high, almost to the pip. If you go back further in time, that's the wrong color, but if you go back further in time, you can see that that same level is pretty much the open of this candle, so the low of this candle and the open of this one. Can you see that? Let's take a look further back and see what else we can spot. That same level is pretty much almost the low also of that candle there. And this candle is not far from it. You can go back in time. You can see here, it is pretty much the high of this one. You will see this repeat itself over and over and over again in your charts. Once you see this correctly, you cannot unsee it. It will haunt you. You will open up a chart and all you will see is this. One second. Let me move this out of the way. Okay, that's fine. All you will see is this. And so, Reggie, to come back to your original question, I submit to you that with some degree of confidence, it was not beyond the realm of feasibility to have predicted this as the high of this day in question. One second, my MT4 just froze. Okay. So, this isn't 2020 hindsight. This is something that you can actually predict in pretty much real time. Once this day started, that line here, based on that point, all you need is 2 or 3 to confirm. You know, all you need is 2 or 3 to confirm. You got one here, and it doesn't matter how far back you have to go because market makers are position traders, and a couple here. That line should have been on your chart that day. There's no guarantee that would have been the high, but it would have been a candidate. You should have had that line superimposed on your chart waiting for reaction, and you would have gotten your reaction. Let's look at the low. It's the low there. One second. It's also the low. It's the low here. At that point there. It's almost a high here. Almost a high here. Pretty much a couple of pips away. It's pretty much the open. One second. It's pretty much the open here and also the close there. And you go back, just see it. One second, I'm messing that one up. Again, you just go back and you see it. It's, look at this there. Now, it doesn't need to be accurate to the exact pip. It's just telling you that something's going on in that region right there. And so, when this candle was forming that day, you could have with fairly confident expectation, you should have had those 2 lines on your chart and been waiting for a reaction. Now, I'm not going to show this because of time, but the same thing with this level, this candle here. You just trace that green line back in time, and you can see all the times there's a reaction in the past. These 2 green lines, can you see that? So, like I said, on day 1, for those of you who started a couple of weeks ago, price action is like an elephant running through your back garden. The market maker is an elephant. There is no way an elephant can hide their tracks. The question is, can you spot those tracks? Now, let me prove this. You know, I told you open, low, high, close for a bullish candle, and then open, high, low, close for a bearish candle. Let me prove it to you. I have already proven this to some of you, so stick with me through this. This candle formed on the 1st of August, right? Let's jump down into a 1 hour chart, because we know that a daily candle is a divider on a 1 hour chart. So on a 1 hour chart, each of these dividers represents one day. And this is one of the ways that you should be trading as a professional trader. By professional, I don't mean you're a full-time trader. I just mean you're trading with professional approach, or with a professional approach. Is you want to be superimposing your analysis from a higher time frame to a lower time frame in which one candle is one divider. Write that down. You want to be moving from candle to divider. So for instance, one monthly candle is a divider on a daily chart. Every candle that forms on a monthly time frame is one divider on a daily chart. Write that down. So if you are trading the daily time frame as your reference time frame, remember, reference, bias, level, entry, management. You want to be working with 4, sometimes 5 time frames. But if your daily time frame is your reference time frame, you need to understand what the candles are doing on a monthly chart. Do not attempt to trade with the daily as your reference time frame if you don't have an informed idea of how your monthly candles are forming. One candle on a weekly time frame. Are you guys following me in the comment section? Let me know you're following me. One candle in the weekly time frame is equivalent to one divider on a 4-hour chart. Every weekly candle shows up as a 4-hour divider. So do not attempt to trade with the weekly time, with the 4-hour as your reference time frame if you haven't figured out what is going on with the weekly candles. And finally, every daily candle, so every candle on the daily time frame, is the equivalent of a divider on anything from a 1-hour chart downward. So whether it's 1 hour, 30 minutes, 15 minutes, 5 minutes, or 1 minute chart, each of them have a day as their divider. Now, the same principles work on a 1 minute chart as work on a monthly chart. However, write this down as well. The higher the time frame, the more reliable the signal. It's like a poll. If you come out with statistics after polling 5,000 people, you're going to get a more accurate representation. So if you ask 5,000 people whether or not they will vote for one political party or the other, you're going to get a more accurate representation of the population than if you asked 500. Or if you asked 50 or 5. So a monthly candle is taking an entire month of information into account. A 1 minute candle is taking just 1 minute of information. Price still works the exact same way. Let me show you. Look, see, it's the exact same thing. Look at this, right? Exact same thing. 1 second. Stop hunt, right? Market structure break. Return to level of market structure break. Fibonacci, 50%, fair value gap, expansion. It's the same principle. However, you're going to get a lot of noise on a lower time frame. We call it noise, meaning false signals, things that are not easily predictable because there's too many other blocks, too many, on a high time frame, they're less and more reliable. And so you want to go from a reliable time frame, meaning one of these top three. Market makers are not interested in anything below a daily chart. Sometimes they'll look at a 4-hour chart. They're making their calculations of these three time frames. So you want to follow institutional order flow on these three time frames and then drop down to the time frame where the divider matches the candle. So for instance, now that I've made that point, let's go back to why I made it. This candle formed on the 1st of July. You see that there? That candle we just analyzed formed, one quick second, I need to sort something out here. Right. Cool. Stop popping up. Excellent. Right, so it formed on the 1st of July here. That's the one we're looking at, 1st of July. So let's drop down to a 1-hour chart and let's find the 1st of July, shall we? 1st of July on an hourly chart. So this is the 1st of July. Can you see this here? An 8-hour chart. I'm assuming you're using TradingView platform, right, Kiran? In my opinion, this is just me personally. You don't have to take my approach. This is not a rule, just my opinion. I have come to figure out that the MetaTrader 4 time frames are pretty much the only ones you need. The other ones, in my humble opinion, I know there's people who really love the 2-hourly chart, so the 240-minute chart. They swear by it. That's great. I have found that these 8 or 9 time frames are the most significant. So I don't use TradingView. I use MetaTrader 4, and I don't see the need personally for an 8-hour chart because all I need to know, in my opinion, I can get from the 4-hour or the daily. But that's just me personally. If it works for you, great. So like I said, just find 2 time frames where the candlestick on the higher one matches a divider on the lower one, and this works. So this is the 1st of July, right here. This right here is the 1st of July, 2020. Let's blow that up a little bit. So that's the 1st of July there. This day is the 1st of July. Remember what I said? On an up day, remember I told you that on an up day, on a bullish candle, so up day, 4-hour, month, whatever time frame it is, if that candle is going to be bullish, 90% of the time, it will open, then go to the low, then run to the high, and then close short of the high. Well, let's see if I was right. 1st of July. Ladies and gentlemen, would you agree with me that this was the open? 1 second. Would you agree with me that this was the open for that day? Would you agree that this here was the open for that day? Let me know if you would agree. Okay. Where did price go after the open? It went straight for the low, right? Some days it will first go up and then come down. But if it's going to be a bullish day, 9.5 times out of 10, no matter what it does initially, it will first make the low of the day. What happens at the low of the day? We have a 1 hour engulfing, right? Right? That's 1 hour engulfing. You see that? What happens after the engulfing? We see a market structure break. But even before the market structure break, it goes back to visit that engulfing, because the market maker can't get all their orders filled in one go. They have to come back to pick up the unfilled orders. And then where does it go first? Where does it go straight to? It goes straight to the high of the day. Can you see that there? What happens at the high of the day? Again, there is another 1 hour engulfing, right? And then it forms the close beneath that level there. That's the close, pretty much at that level there. Then it closes. Can you see that? Open, low, high, close. Do you understand how significant this is? Especially to the more experienced traders here. Reggie, Kieran, Joshua. I'm not sure who else is on the chat today. I'm not sure if my Uncle Wally is here. My Uncle Wally is here. Do you understand how significant that is? Just let that sink in for a second. Let that sink in for a second. That is life-changing if you know what to do with it. Because, like I said, if you can predict successfully with any degree of accuracy where the low will form, you're in business. Also, not only is this low forming at this level, which we saw on the daily chart, previous daily candles have reacted to, there will usually always, let's see, Joe's asking a question. Does this mean while an up candle is forming on a daily chart, you can go on an hour chart? Gerard, can we close the class? I can close the class here with this comment, and if you get what Gerard has just posted, you will have got the gist of, or at least a huge chunk of the gist of what I'm trying to pass across. While that candle is forming, it could be a day if you're coming from the daily chart. It could be a week if you're coming from the weekly chart. In essence, if you're trying to predict your week, figure out how you expect that week's candle to form, drop down to a 4-hour chart, and catch the open, low, high, and close. On the flip side, if it's a day, figure out how you expect the daily candle to form, drop down to a 1 hour or 15-minute chart. I wouldn't go any lower than a 15-minute chart for this. For this particular principle, I would not go any lower than a 15-minute chart, because 5 on 1 minute, the noise is just too much. And try and catch the open, low, high, and close. It really is that simple. It's not rocket science. It's not hard. It is so simple. Your mother could do it. And mine does. My mother trades. It's that simple. All right. So let's go back to the day in question. First of July. Are you guys getting value for your time here tonight? Is this, especially the experienced traders, is this worth your while? Now, not only is that forming. So now we have a confluence. So for those saying, how do I know for a fact where it's going to form? Well, you don't know for a fact exactly where it's going to form. But as that elephant is running through your garden, as that elephant is, okay, so Reggie says, no, Kieran says, but the low is considered low as of now. It could go lower. True, in which case you need proof that that was the low, which is why I said 1, engulfing, 2, market structure break, 3, a revisit. So if you remember from yesterday, when we gave the examples yesterday, let's see if I can find those charts we used yesterday. Let's see if I can find them. Where are they? Can I find them? When we're doing our 1, 2, 3, 4, 5 and beyond, and we said sometimes you don't know that was the 1 until the 2 forms. Remember that, right? So yes, there are times where you may not know that the low has formed until something else happens after the low that tells you, oh, okay, yeah, this is it. So let's see now. So this was 1, that was 2. And we said you would not know it was a 1 until 2 has formed. So you're right. But anyway, going back to where we were today. Where were we today? Yeah. So you have that level from previous days coming into the day that you're watching. You get your engulfing. You get your market structure break. This was the market structure break here. That was the first market structure break on the 1 hour chart. The first 1 hour high that was taken. It comes back down into that. Now, it doesn't need to come back here, is the honest truth. Anything beneath this line that gives you another reaction is valid. But this is the beauty of price. It will usually give you a liquidity profile from the last 2 periods. Write this down. If you're trading the weekly chart to a 4 hour from the last 2 weeks, if you're trading a daily chart down to the 1 hour from the last 2 days, if you're trading a monthly chart down to a daily chart from the last 2 months, check the last 2 periods, the last 2 dividers. There will be a clue. Look at this here for me, everybody, real quick. Just look at this real quick for me. And this is what supply and demand zone traders don't show you, because they don't understand that price is price. If it was significant here, it will be significant over here. It doesn't matter. We say, oh, don't cut through candles. The market maker doesn't care about the fact that we're cutting through candles. Back 2 days ago, this was a significant price zone, right? This was a bearish order block, right? 2 days ago, price was coming up and then reversed down and formed this bearish order block here. Well, the next day it blew through the order block. Good. But when it comes back down on the 3rd day, notice what it does. It respects it. This happens all the time. Sometimes it's from the previous day. Now, I want you look at that candle there. Look at this candle here, right? Look at that level there for me. This may mean nothing to you if you're an inexperienced trader looking at a 1 hour chart. But I want to drop this down to a 15-minute chart. 1st of July. Can you see that there? That, ladies and gentlemen, is a 15-minute low. That is a 15-minute order block. Can you see that there? And so you have the confluence. The level you came into the day watching, the order block from the previous day, the mega order block from 2 days ago, from 2 days ago, and the fact that this is beneath the low of the day. 1, 2, 3, 4, 5, 6. The elephant is begging you, saying, hop on board. If you didn't take this trade, you got no one but yourself to blame. Now, it's not always this clean. I'll be the first to admit. There's days where you get a 1, 2, and a 3, and that's it. There's days where you get 2, and that's it. I usually go for at least 3 pieces of confirmation. Right? I like 3. 3 is a nice number, you know. Whatever your religious faith is, there's a verse in the Christian Bible that says, in the mouth of 2 or 3 witnesses, you can confirm a matter. So scientists teach us that when you're plotting a straight line, you want 2 coordinates and a 3rd coordinate to check that line is correct. 1, 2, 3, 4. I mean, some days won't be, but this day was begging you to take this trade. It goes up. What piece of confirmation do you have for there? Well, let's see. Let's go back to a 1-hour chart. So 1st of July, how could I have known this high was going to form here? Let me get rid of that for a second. Well, can you see that order block right there? Can you see that order block right there? Can I interest you in some of that? It was respected this day. It comes back here, respects this, blows through it. Actually, sorry, that's the wrong one I'm looking at. It's this one. This one at the top here. So I'm looking at the wrong day. This is, sorry. This is the day in question. So that would be this one here. This order block there to the high. Yep, that one. Look at the confluence. Order block, previous level, 1 hour reaction off that. And so using this principle here with some accuracy, it's not a perfect science. You will get it wrong every now and again. But like I showed you several times, remember this formula. Let me remind you of this formula. If you trade with 5-1, meaning if your trades are taken, okay, look at this, guys. Before we go there, just look at this here. Can you see that today closed? Today closed at the exact same level as the low of this candle. And I was watching it form while we were talking. I didn't say anything, but look at it. Today, or the previous, well, it's a new day in Asia. It's still Wednesday in London and in the States. It's already Thursday in Asia. But look at that candle closed. So if I just drew a line from this candle's close, I could have with specific precision predicted this one here. That's an example that formed while we were teaching. But all you need to do is split the difference with the market maker. If you take 10 trades and have 5 wins and 5 losses at 5-1, and this example was on an account where 1% was $250, you will walk away at least $20 up, 20% up every 10 trades. You only need to be right half the time. If you're going 4-1, you'll be up 15%. If you're going 3-1, you'll be up 10%. If you're going 2-1, you'll be up 5%. And that's just by losing as many as you win. If you ever get the hang of this and can bump it from 50% to 60 or 70, you're off to the races. And so it doesn't matter whether or not you get it right every single time. It matters that you have a filter that gives you at least a 50% chance of getting it right. And you maximize your profit when you get it right. You minimize your losses when you get it wrong, either due to incorrect analysis, inexperience, or just the fact that the market maker or the market itself just faked you out that day. Let's look at the opposite. Let's look at this candle here. It formed on the 11th of June, right? It was a bearish candle. Let's drop down to 1 hour chart and find the 11th of June. On a 11th of June on a 1 hour chart. Let's get that and move it with us to use when we get there. So this is the 11th of June, right? No, that's the 12th. This is the 11th of June. Cool. Now, notice something. Notice here that on a daily chart, this bar we drew was the body of the candle, right? Well, notice that when we drop down to 1 hour chart, it shows us what I call the profile range, right? The difference, I've moved that, whatever, I'll correct that later. It shows us the difference (11th of June). The difference between, there we go, the open and the close. Can you see that there? That bar shows us the difference between the open here and the close down here. June 2020. And what do we see? It opens. Notice this is one of those days that tries to fake you out, right? But you're not buying it. Even when it starts, now this is a day with a very small wick. Remember on the daily chart, this was a very small wick. But still see, it opens, it goes above, forms the high there, right? Drops down, forms the low, comes back and closes. So that's a day with a small wick. Let's find a day with a bit of teeth to it. A bearish day with a bit of teeth to it. Let's see. Let's go back here. Let's use, so by teeth I mean wick. So let's use, if this is the 11th, let's use the 12th. The very next day is the 12th, right? This has a significant wick. So let's go and use the 12th so that we can see how it forms with a significant wick. So that will be this day here. So the 12th of June. For my Nigerian students, the 12th of June has some significance to you. In which case, 1 second. That was the open. Come on. So that was the open. I'm going to delete that because we know what that was. That's the body of that candle. So I'm also going to get rid of this here because that was from the other day. So my chart is a bit clearer. Right, so get rid of that as well. And that as well. Too many things in your chart at the same time will confuse you. So always be in the habit of cleaning your chart up as you go along. So that's the open here, right? Notice how on this particular day, price is starting to fake you out. Are you going to chase this? No. Someone say no. No. Because if you have correctly analyzed here, why would you think this day would be a down day? Well, very simple. There is a stop hunt here. 2 days before, price takes out the previous day's high. So there's a stop hunt to the upside and then a market structure break to the downside. So we have our, using our numbering system. Once we see this 2 here, this would have been our 2. The market structure break would have been our 2. We can then retroactively go and find our 1. This is our 1. The stop hunt that led to the market structure break. So we start counting, right? What are we looking for? We're looking for the 3, where price comes back into this level, right? And so this here is the 3. This is the 3. Remember, guys? For those of you who don't know what 1, 2, 3, 4 is, go watch the previous videos. They will be on the Telegram in the right order. And so, before this day forms, before the 12th of July forms, right? On the 11th of July, we have our 2. We have post-datedly marked up our 1. What are we waiting for? A 3. We want price to run away from there and come back inside this level, right? Okay. So when this day starts and price starts dropping, are we chasing it? No. Why? Because we know how it's going to work. If it's a bearish day, and we do expect this day to be a bearish day based on what happened the previous 2 days, we are waiting for price to come back. And notice, to come back above the open. So when it comes above the open and it forms this signal here, this is how you filter the signals. Are you taking, so before that formed there, look. Are you taking that engulfing? No. Why? Because you are waiting for a 3. There is the odd time the 3 will not form. That's fine. But you're sticking to your rules. You're waiting for the 3. Well, the 3 forms above the open of the day and above the market structure break level. And then you have a 1 hour engulfing, which now you can trust, right? Now you can trust this. Well, what does it do? It goes to the low here. Where is this low? Notice the low forms around this significant level, which in the past has been significant. On a daily chart, that level has been significant several times in the past. Look, that's where the low forms. And then the low will retrace back to form the close. And the close is formed here. Ladies and gentlemen, it ain't rocket science. Also, if you want to get extra confirmation, well, just put your Fibonacci in. Where is the current swing? The current swing is from here to there. Look at that, right? High, low, 61.8 retracement to get your high, right? Where would you expect, if it formed at 6, where would you expect your low to form? Well, somewhere between the 121 and the 1618. And what do you know? That's the low there at that level. Do you get this for now? There's more to come, but can you see it? Because I want to end there today. I want to also give a chance to ask questions. Do you get the premise of what we have just looked at today? Before I ask for questions. Let me know in the comment section. Do you get the premise and the significance of what we have just looked at today? So these candlesticks are not just forming willy-nilly. They're telling a story. And we're going to look at this tomorrow, in tomorrow's session. Candlesticks part 2. There is a reason why on any particular month, week, day, or 4 hour, this doesn't apply anything beneath the 4 hour chart. But anything from a month down to a 4 hour, there is a reason why that candle opened there, closed there, formed that high, and formed that low. You don't need to know the reason. Just know a market maker saw it necessary. Let's do this on the daily chart. A market maker saw it necessary. Get rid of this. Because nothing they do is insignificant. We don't need to know why they did it. Like I said about the elephant, you just need to know what it means moving forwards. And of course, as you get more matured, as you get more experienced, you will start to figure out the whys, and some of the whys will make you laugh. Like sometimes I can see some things happen on the chart, and I just know what's going to happen in real life in the financial markets. I'm going to hear some news in the next 24 hours, or I can hear some news and I just know, I just go laughing, chuckling. I know exactly what's going to show up on the chart, and it's nice, it's fun, it's very amusing, as long as you are not losing money because of it. So there's a reason why price opened there. The market maker thought that was a significant place to open that day. There's a reason why it closed there. There's a reason why that was the high it formed before it dropped. And there's a reason why this was the low it formed before it closed and retraced. Those reasons will hold into the future. So if the market maker thought this was a significant level that day, you bet your bottom dollar it will be significant in the future. That level will be the high, the open, the low, or the close of a future daily candle to within a few pips. Look at that. That respects it there. That respects it there. Kieran, I'm going to answer your question in a second. Just hold that thought. Great question. Hold that thought. If that was the open, well, it's going to be significant in the future. Look. If that was the close, it's going to be significant in the future. Look at that. And if that was the low, again, it's going to be significant in the future. Can you guys see that? And this is what you do with days where you either missed a trade or lost the trade. Missed means you didn't get a chance to enter. Lost means you entered and you lost the trade. This is why you should journal your trades. And that's why you shouldn't be taking too many of them, because you can't journal if you are taking 50 trades a day. That information you gain will help you moving forwards. It just will. And as you get more experience, you'll be able to figure out in real time what it means. So, Kieran's question. Don't the big guys know these tricks themselves? They do, but Kieran, Kieran, please write this down. I need you to get this. When we look at the chart, we are seeing what they've already done. Write that down. Price action is about seeing what a market maker has already done and what it means for the future. So, to us, it is confirmation. To them, it is consequence. They cannot trade the way they need to trade. I did a video 2-3 weeks ago, Kieran. I'll send it to you. I'll look for it and send it to you privately in a Telegram chat that talks about it's actually a playlist, a market maker playlist, and it's not done. I'm coming back to it in a week or so. I just needed to give you this intermediate understandings before we go back to that that series. They don't have any other way to trade. You can't take out or put in hundreds of millions or tens of billions of dollars into the market without leaving footprints. They can't change the signature because there's no other way for them to trade. They need pockets of liquidity. They need to avoid huge slippage. They need to price in their orders and price out of their orders. So they're tied. There's only so much they can do to mask their movements. Your job is to spot it. This was a market maker doing something. What does it mean moving forwards? If they got in here, they're going to need to get out at a similar level on their way back. If they priced in, they're going to need to price out. If they want to get out, they need a liquidity pool, P-O-O-L, and therefore there will be a liquidity pool, P-U-L-L. These are the principles that form the story behind price action. So when you start slapping your indicators on the chart, for those of you who like to use indicators, I don't, because I think the indicators get you so focused on them that they actually hide the story. But if you can do two things at once, if you can keep your eyes on the price action story, not the indicators then confirm to you, yes, this is a likely trade because the indicator is telling you what price action has already said. So I teach you guys, if you must use indicators, use them as filters for a trade, not as the signal. Use the indicator to tell you that your price action signal is likely to play out. Reggie says, need to be able to spot the fake outs. Yep, we will look at that as we build on the course. Because let me close with this. Now, you guys were in the Telegram section today, right? So this is not 2020 hindsight. I called this today as it was happening. For those of you in the Telegram chat, you saw me call this today in real time, right? Cool. We were looking at a 1 hour chart. Price came here. Remember I drew out this zone? There's an order block there. There's a fair value gap there. I drew out this zone and this reaction. Truth of the matter is, I actually opened up the trade. Right, let me see. 1 second. Let me find it. Okay, got it. I actually opened up this trade on this account right here based on what initially looked to me at first glance like a perfectly reasonable price action model, right? There was a fair value gap here. Fair value gap here. So much for saying I wanted today to be a short session, right? Well, we'll be done in a second. There's a fair value gap there. There's an order block there. The Fibonacci range was perfect. Right? That at the time this formed, remember when this formed, that was all I could see. It was all I could see when it formed. 78.6. Everything looked perfect. And I got in there. And I closed the trade. Literally within about 10 minutes. Why? For those of you who wondered, let me show you why I told you get out or don't get in immediately. And I was right. Look, I was right, right? Let's break this down real quick. Let's go back to that chart. So, you know what? Let's use a brand new one. GU. So using what I just said to you, right? The day in question, was this one. I was trying to predict how this candle was going to form. This one in the middle, right? Today. Oh, that was, well, it's today in London, the 15th of July. It's already Thursday in Asia, but it's today in London and also in New York. My job was to predict how this candle was going to form. Well, my prediction was simple. The previous day's candle was a doji. We'll look at that in a few sessions. Price went down and something drove it up. This is a powerful bullish signal. So there was plenty of suggestion that today was going to close above where it opened. But I'd also drawn this out here. And so I expected a reaction in there. I got it a few days before, and this was revisiting. Now, I want you to look at something for me real nice. Look at this real nice, right? We're talking about open highs, lows, and closes, right? Look at that there. Look at the close of that candle. Look at how the next 4 days respects it significantly. This day respects it fairly significantly, right? So initially, on a 1 hour chart, I didn't show it to you, or I don't think I did, but this was why my first instinct was to do this, which was the first chart I showed you. That was where that came from. However, I went away and I saw this here. And when I saw it, I wondered, why did I not see this? From here to there, there is an intermediate liquidity pool there. Look at this here. This here would have had a significant amount of liquidity above it. Let's get rid of this now. There would have been a significant amount of liquidity above it here, running into that order block as well. Also, now I knew there was going to be a short at some point in the day. The question was, where is the short coming from? Because market structure break, return, where is the short coming from? Well, let's go back to a daily chart. Let's see if we can make sense of why that was the significant level. Well, one, it is the high, the open of this candle here. This was the beginning of the move that drove it down. But secondly, and more significantly, if you just throw that on there, can you see this, ladies and gents? 1, 2, 3, 4, 5. So coming in, I'm faced with a choice of two zones. The first zone is here, which is where I initially entered and came out immediately. The second zone lines up perfectly on a daily chart. Remember, I'm coming from a daily to a 1 hour. Lines up perfectly with this. If I were to have drawn the first one, it would have been this. So this would have been it, right? So higher line, lower line. Well, if you look at a daily chart, which of those two lines seems more significant to you? If you go back in time, they're fairly close to each other in the daily chart. But which of them seems more significant to you? If you were going to choose one of them, which one would you choose? Talk to me, people. If you were going to choose one of them, which one would you choose? Based on this region here. Which of those two lines, bearing in mind that choosing the wrong one could cost you money intraday, which is the safer one to have chosen as your level? I'm waiting for the answers in the comment section. Answers, comments. Reggie says the lower one is safer. Is it really safer? You're scared. Okay. Let's go back and look at it properly. Look. Bear in mind, when the day started, we were down here. The day started down there, right? So we're going up. We're going up into one of those two lines. Whichever line we choose is where we're going to put our stop loss. We're going to enter the trade at one of those two lines to come the other way and put our stop loss based on the line. First of all, on this day, price blows through the lower line and gets to the top one. So let's put that there. Let's put it at the exact tip there, right? And then when it comes back there, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 2 weeks later, it again blows through the lower line and gets to the top one. So in April, price showed you that it did not respect the bottom line as much as the top line. Twice in April. And we're back at that same level now in July. If I stop at the bottom line and I'm wrong, I will lose. If I don't stop there and price does react to it, I can always get in on the trade further down. And so since I'm trading live money, hard-earned money, and I'm not in the business of donating my money to a market maker, I said, nope, I don't trust that one. That was what happened today. I took a long, hard look at it. And as you can see from my chart, let's see if I can find the chart I was trading. You can see I analyzed the heck out of it. And I was like, nah. I got out down there. So it hadn't reversed when I got out. Let me see if I can find the Telegram. Because guys, this is not 2020 hindsight, right? First of all, this did play out, didn't it? On the Swissy. That was very, very correct. I just didn't take it. But that was very, very correct because I was waiting for the GU. That did play out on the EU like we called it 2 days ago. So we were correct. Now, initially, that was what I was going to take. But then I said, actually, and also, actually, this is Swissy. So, okay, it's going in. That's fine. What am I looking for here? So I wrote D1 Doji formed last night. That's actually a bullish signal. I shouldn't hate from below. So that's the Doji saying we're going up into that level. And the day before I saw market structure break. In essence, what this told me was we'd had a 1 and a 2 and a 3, roughly. Well, that's not quite a 3 yet, so I suspect we're still going to come further down, which we did eventually. So I was expecting my 3. The short I was going to take was my 1, 2, and then 3, which we got. But because of this here, I said, I'm not trusting this one. I'd rather be out of a trade that was coming down saying, oh, snap, I wish I'd taken the trade, than be in a trade that's going up thinking, why did I take the trade? Now, when did it form the high? Because I didn't take this trade. It formed the high at 2:30. But by the time I got my engulfing, my 1 hour engulfing, it was 3 o'clock. 5 p.m. in my server times, 3 o'clock London time. Gerard, Priscilla, Esther, Natalia, can one of you tell the people where I was at 3 o'clock today? Between 2:30 and 3 o'clock, what was I doing today? Because you guys were on that same platform with me. Can you tell the good people what I was doing between 2:30 and 3 o'clock this afternoon? Yeah, there's a delay in the comments. Well, you guys will see it when they write it, but I was on a live TV broadcast. Yep, Priscilla, got it. Kingdom in Motion. I was on a live broadcast. And I saw it. I saw the trade. Right? I saw the trade. But I was on quote unquote television. It was a YouTube show I run every Wednesday. I do a show on Wednesday every YouTube. It has nothing to do with trading. It's about real life issues, government, politics, police, things of that nature. I was interviewing a councillor from the local government in the borough where I live and work in London, or I used to live and I still work in London. And I wasn't going to interrupt my broadcast to take that trade, so I just let it go. But this would have been the trade. No, that's the line. This would have been the trade. Enter at the bullish engulfing, meaning once the 1 hour candle closes beneath that one, put your stop loss there. 1, 2, 3. It's all right. It's not special. So this is how you can, in essence, I was calculating coming into the day which or where the high would form, to use Reggie's point. Reggie's question from earlier was, let's see if I can find that question again real quick. There's no way of knowing while the candle is forming. And like I told you, you can't know for sure, but you can have an educated guess. And so while price was rising today, I had a rough idea exactly where I felt it was going to give me the high of the day. I had 2 guesses, 22 pips apart. I decided to wait for the higher one, and I got it. There are days where this would have happened. Now, even if you missed it, market structure break, it gave you a re-entry. The problem with that re-entry was it was at 4 p.m. in the afternoon. I told you, you will not pay me to take a trade except I'm scalping, meaning I'm in and out in 10 minutes. You wouldn't pay me to take a trade with an entry anything past 3 p.m. in the afternoon London time. And so I like, nope, I'm not interested. I could have put my entry there, put my stop loss there, right? So 15 pips. So I can put my entry here, sorry. Put my stop loss there. That's 16 pips. And I would have done 2-1. But why? Why risk it when it's outside the right time zone area? So, nah, just let it go. There'll be another trade tomorrow. But today is a perfect example of how understanding how a candle forms. So in essence, this was my daily candle, doji. So I expected it to come. So there's an engulfing. I expected it to come back, find support somewhere, and then drop. Now, the truth of the matter is, tomorrow could go up even further or down. You only need to work one candle at a time. This is the beauty of trading this way. If I'm working with daily candles, I need to work with one daily candle at a time and superimpose it to an hour chart and try and figure out the high or the low and take my entry from there. If I'm working with a weekly candle, I need to figure out one candle at a time and superimpose to a 4-hour time frame and try and figure out my high, my low, my open, and my close. I am going to end it there today. Go chew on it. We're going to do part 2 of this tomorrow. As we close, just to remind everybody, now, if you are not a registered student, there are some sessions that you will not get access to. And moving on from August, we're going to severely reduce how many of these sessions are actually free to air on YouTube. So they're on here right now, one, as an investment in you, and secondly, just to let you guys out there know that we do know what we're doing, and many of you have found us via YouTube. But starting from August, we're going to perhaps do maximum 2 a week on YouTube, the rest on or free on YouTube. The rest are going to be by private videos. They'll still be on YouTube, but there'll be private links where only the registered students can get them. But this is what we do every week. So we're going to be back tomorrow, 11 a.m. in the morning and 9:15 in the evening. I'm going to carry on with the candlestick session in the evening. The 11 a.m. session is going to be off YouTube. So that's going to be via, it's still going to be YouTube, but it's going to be a private link. And Joshua is going to be working with some of the beginners around things with candlesticks. So even the advanced traders, you can sign up, you can come on for that as well. Where Joshua is going to be working with you with your charts. So it's not going to be a teaching session or a recording session. It's going to be a personal. So yeah, 11 a.m. and 9:15. Yep. Every single day, it's either 11 a.m. and or 9:15 British Standard Time. So the time here is always going to be the time in London. Bear that in mind. So calculate for your time zone, wherever part of the world you're in, calculate based on these times, or calculate from these times based on London. And the 9:15 in the evening, we will deal with candlesticks part 2, where we take what we learned today to the next level. If you do register, this is what you have to look forward to. Market Breakers course, systemic information, theoretical and foundational. The VIP mentorship is what we've been doing on YouTube to a degree for the last few weeks, with the taster sessions you guys have been seeing live. But also it means that you have access to a Telegram group and channels and 3 instructors, myself, Tokbe, and Joshua, depending on what level you're working at, who you can actually have 1-to-1s with, send in your trades, get feedback, get customized, ask questions. That's the VIP. And also mindset and mentality coaching. And starting from August, starting from the 3rd week in August, we're going to be launching, is that August or September? Sorry. We're going to be launching the Mastermind Inner Circle, or 3rd week in August. Yeah. So, which will give signal services. We're going to give you customized trade models based on how you trade. We're going to sit down and say, okay, using institutional order flow with the way you already trade, and this is for experienced traders, here is a trade model with rules you can follow. A, B, C, D, E that you can follow. We're going to be releasing customized watch lists every month, saying these are the pairs we think you should be looking at this month. Showing you some macro market and intermarket analysis, because there's more to spotting these things than just the charts. There's fundamental information that gives you even more refined biases and filters. Access to, we're working on a trading robot, an expert advisor at the moment. Indicators, some of them you see on my charts. And I'm looking forward to November. We hope to have the Traders Village fully operational by November. The Traders Village is going to be social media for traders, pretty much. It's going to be an online platform where we hope to grow it to at least 1,000 traders over the course of a year from when we start, where you can literally walk in and you will be in a virtual trading floor. It'll be like walking into a physical building with 50, 100 other people at trading stations around you, and you can trade together, ask questions, share what you're watching, support each other, create a tribe to make your trading journey more fulfilling. So that's what you have to look forward to. You can get it for $79.99 a month. That's it. This has just gone up not too long ago, where you can get it for $79.99 a month. That's not going to stay at that price forever. Get in right now while you can and be part of the journey. How do you inquire? Well, send an email to israelkeysgroup@gmail.com. So send us an email saying, this is my name, I am interested in joining, and the inquiry is no strings attached. We'll send you some detailed information. You make up your mind. For those of you who found us this way, you know there's no hard sell. We don't keep calling you and disturbing you and chasing you up. You know why? We're so sure of our product that we don't feel the need to harass people about it. We're more interested in being of value than in trying to sell you stuff. But you can also get in touch with us via Telegram or WhatsApp on that number. So send a WhatsApp or Telegram to that number. Great question, Kieran. I'm just waiting for it to pop up on my platform, my broadcast platform, but I can see it in the comment section on my YouTube app on my phone. So once it comes up in my broadcast platform, I will put it on the screen. But Kieran has asked, how do I refer my friends? Tell them to send that email or WhatsApp or Telegram and to mention you. Just tell them to let us know that you referred them. And we are hoping that if you guys are if you're benefiting from this, we are hoping you are our advertising plan. Let's make that clear. We hope to give you so much value and be so beneficial to you that you go scream it from the rooftops and tell everybody you need to be a part of this. So you're our advertising plan. Word of mouth. We want you to be so excited about what you're getting and the transformation it's bringing to your trading journey that you can't keep quiet. And so we do really ask you to refer. And this is the time for them to get in while the prices are still low. Because they get in at this price because we're still crossing some I's and dotting some T's with our technology delivery service. Once everything is fully sorted out, the website's fully built, the Mastermind Circle is fully up and running, and the Traders Village is operational, this price will almost double overnight. And even if it almost doubles, we think it will still be great value for what you're getting. Show me one other place where you get all this every single week and all this for anywhere near this price or double. Where's the price again? Where's that? For this price or double, and we will go back and see what we can do to match it, but you won't find it. All right, guys, thank you for listening, especially to the spiel at the end. Registered students, please make sure you watch the Telegram channels for signals announcements all week. Make sure your Telegram is set to deliver notifications, so you need to know when we're trying to get a hold of you. All right, take care, guys. See you at 11 a.m. tomorrow. It'll be on YouTube, but only registered students will have access to it. Everybody else, I will see you tomorrow evening at 9:15 p.m. British time. Take care. Have a great week. Bye-bye.